thank you so much for joining our webinar today to discuss the latest developments and insights coming out of Washington. It's certainly the proverbial gift that keeps on giving. Based on the registration list, it looks like we have a really nice mix of both clients as well as outside partners, colleagues, and friends. So most of you probably know me, but for those who don't, my name is Omar Qureshi, and I'm a partner here at Hightower Wealth Advisors in St. Louis, focusing on both managing client relationships as well as leading our investment strategy for the firm. For the families we do serve and are quite proud to serve, we call ourselves a wealth management firm, which is another way of saying we make sure no piece of a client's wealth puzzle is ignored in pursuit of our mantra, which is make a plan, make an investment, and make a difference. In that spirit, we wanted to bring you a resource today to help navigate these unprecedented times. And as they say, truth is stranger than fiction, and even the best writers in Hollywood couldn't have crafted a storyline to match what we've seen in just a few short months. And regretfully, on many accounts, the story seems to be far from over. We're living in a time that is putting leaders of all stripes in the spotlight as they attempt to guide their constituents through the myriad of uncertainties. And given the backdrop of really the historic government interventions, as well as the upcoming elections, we're really pleased to bring you a friend, Jeff Bush, who's going to share his mostly nonpartisan thoughts on some of today's most crucial topics. Jeff is a 30-year plus veteran of the financial industry and is a dynamic and insightful speaker and author, known for his unique ability to translate difficult and confusing information, which that pretty much sums up Washington, into strategies that can be implemented by business owners, executives, and high net worth investors. Jeff's a colleague of Andy Freeman and an integral part of the Washington Update, the industry's nonpartisan experts on all things Washington. Jeff presents more than 200 times a year. So to your earlier comment, Jeff, you're all over the country to a client base who's really a who's who of Fortune 500 firms from Wall Street to Main Street and everything in between. Jeff's a frequent guest on CNBC and is featured in too many publications to mention here. So Jeff, welcome. Let me just say thank you first and foremost for joining us, and a special thanks to Eaton Vance for bringing Jeff as a resource for our friends and clients.
Well, thank you, Omar. I certainly appreciate that. And just let me get the screen up for everybody here, and we'll get started. Well, does it look fine on your side, Omar?
Yeah, looks great. Thank you.
Great. Excellent. Excellent. Well, I do appreciate the opportunity to be here. And I thought when I address this audience, I really ought to come up with a picture or a metaphor, if you will, for how politics has felt over the last 6 to 7 months. And it wasn't until I came across this picture of this road sign that I thought that's perfect. That's exactly how it's felt in 2020 in Washington, D.C. Now, we have a plethora of things that we could talk about, but we're somewhat limited on our time frame today. So I thought we'd focus on the coronavirus relief efforts, as well as the impact around trade and infrastructure. But there's also impact on the fiscal policy of the United States, and obviously monetary as well. All of those things are laying across the backdrop of a national election in 2020. So in order to get started, we'll start with the coronavirus relief efforts. The old saying that nothing gets done during an election year. Well, who knew if you wanted to spend $2.8 trillion, guess what? You can get a lot of big things done. And that's exactly what we've seen around this coronavirus relief effort. But as financially savvy people, it's even hard for you and I to get our heads around a number like $2.8 trillion. So let me put that into a little perspective for you. During fiscal year 2019, the federal government brought in from all federal tax revenue sources only $3.46 trillion for the entire year. And here we're talking about spending $2.8 trillion basically over 8 to 10 weeks. So hopefully that gives you some perspective of just how big this governmental effort has been to keep our economy going while dealing with this virus issue. But as you know, we're not done then. Between round 3.5 and 4, we actually had something called the PPP Flexibility Act program. As you're well aware, the PPP program is the Paycheck Protection Program designed to help smaller business owners weather the storm of the coronavirus. Now, initially, those monies were scheduled to be spent over 8 weeks until the end of June. But what we figured out with the coronavirus, and it's quite obvious at this point, is that it's going to be a much longer event than 8 weeks. So the PPP Flexibility Act extended that spend time frame to 24 weeks or 12/31/20, whichever comes first, depending on when you apply for that loan. They also changed the date at which the staffing measurement is calculated for forgiveness away from 7/1 basically to 12/1/20, dealing with that real reality. The payroll requirement was dropped from 75% to 60%, and the minimum maturity date was extended to 5 years, giving business owners more time to let the economy recover, get those sales back up to where they were prior to the pandemic, and then be able to start more aggressively paying off those notes. What it also clarified is that PPP participants are also able to participate in the payroll tax deferments that was a part of the CARES Act. Originally, if you participate in PPP, you would not, as a business owner, be able to deduct or defer those payroll taxes. Well, they clarified that yes, you are able to still do that. As you know, that there was still some money left in the PPP program, a little over $100 billion after the second round of funding. What Steve Mnuchin also clarified for us in a committee hearing is that loans can be partially forgiven. So as companies come back, and I think of restaurants in this kind of context, clearly they're not going to be back to 100% before any time soon. And so by the time they calculate that PPP forgiveness amount, they may still not be back to full speed. So there is partial loan forgiveness with the PPP program. Sadly, what the PPP Flexibility Act did not address is the deductibility of expenses. What we found out, again, from Treasury is if you take a PPP loan as a business owner and you get forgiveness, but you paid normally deductible expenses with that PPP forgiven loan, you're not able to deduct those expenses in that tax year. Well, that clearly was not the intent of Congress, but yet it's somewhat conventional with Treasury's understanding of how those monies flow. I would not be surprised if that clarification in round 4 comes around that, yes, those expenses, even if they were covered by a forgivable loan, will be tax deductible. Now, obviously, we're heading into a round 4 discussion, and we know the House of Representatives laid the marker down at a $3 trillion package. Now, they never expected that that would actually pass. It was just laying out where they wanted to start their negotiations. As a matter of fact, Nancy Pelosi just yesterday suggested it needs to even go a little bit higher if President Trump insists that schools open unfettered in August and September of this year. But the Republicans are not going to go along with a $3 trillion package. They want something scaled back. And what we are seeing is there's some areas of agreement coming together around round 4. So I thought that would be beneficial for our discussion today. For example, one of the big cornerstones of a round 4 package will be aid to states and municipalities. We know those organizations rely on income taxes and sales tax revenue to fund operations, and we know their expenses are increased due to the coronavirus relief. So that was a bad combination for states and municipalities, and the Democrats wanted to compensate the states and municipalities to the tune of $1 trillion. Now, Republicans said, no way, we're not going to go along with $1 trillion. We're not going to be bailing out states who mismanaged primarily their pension funds from years past. What they want to do is a number somewhere around $500 billion, but tie that relief specifically to coronavirus expenses only. Now, we're big people here. We understand once $500 billion hits the state's budgets, guess what? That frees up other monies for the state to go spend on other priorities. So it just gives Republicans political cover that they're not bailing out states' pension plans. Another area, as I alluded to a moment ago, is around school funding. Clearly, there's a big effort to get schools re-engaged, but we know it's not going to be as simple as bringing the kids back. There's going to be a tremendous amount of expense in trying to bring back children successfully back to school and university and so forth. And so the federal government is probably going to enhance that round 4 package with specific school funding dollars for coronavirus relief. What we also anticipate is some additional controls around the PPP program, or revamping the program completely, reallocating those unused monies in a different way. We know in the original PPP program, there were companies that we could argue probably were not meant to get PPP loans that got them, and obviously they want to tighten those controls up. There's also some talk about expanding the refundable employment tax credit. Right now, it's a 50% tax credit up to $45,000 of wages. But again, now realizing that this is a longer-term issue that we're dealing with, some Democrats and some Republicans are suggesting that those numbers need to go up. Maybe a refundable tax credit to the extent of 80 to 100% of an employee's income, all the way up to 100% or $100,000 in compensation per year. What we do know is one of the other cornerstones of round 4 will be around employer and/or worker protection. Republicans are very focused on giving employers and schools and the like liability protection to bring back employees so that employees can't sue if they get exposed to the coronavirus at work. Whereas Democrats are much more focused on worker protection. Well, there's enough synergy there that I do believe that certainly liability protection will be a part of round 4. It will be some blending of employer liability protection as well as worker protections also. There's also renewed interest in sending additional dollars to individuals, not unlike those $1,200 checks that most Americans received back in April and May. But going beyond that, the real issue as it relates to individuals is the expiring unemployment insurance at the federal level. We know the federal government supplemented state unemployment programs to the tune of $600 per week for a lot of Americans. But for 2/3 of those Americans, that was actually more income than they were receiving when they were employed. So Republicans are very concerned that that provided a disincentive to return to work. So what Republicans seem to be warming up to is an idea of tweaking that plan from an unemployment program to a return to work bonus, or some type of limited expansion of unemployment, probably by dropping those dollar amounts to $200 or $400 a week up to 100% of pre-COVID income. There is still some interest on the part of the president and the Democrats to make round 4 include the infrastructure investments in our country, and I'll talk about infrastructure in more detail here in a moment. Republicans in the Senate are much more hesitant to include it in round 4. But there are also some tax changes being discussed that we need to understand as well. For example, there is some discussion about reducing or even eliminating payroll taxes during this COVID period. That would effectively increase take-home pay for employees and increase the net income for employers. At the same time, and probably even more creative, is having the corporate rate from 21% to 10.5% for any corporations that repatriate jobs or revenue streams back to the United States. One thing we've realized through this pandemic is we are way too dependent on the rest of the world for strategically important goods, so this would provide an incentive to bring that manufacturing back to the United States. Some have floated a capital gains tax cut. I know that sounds exciting and so forth. I just don't see that happening in round 4, and quite honestly, I don't see how that would actually stimulate the economy. One other area is extending full expensing for corporate purchases and capital purchases beyond the 2022 deadline that came out of the Tax Cuts and Jobs Act of 2017. President Trump is very focused on allowing businesses to deduct 100% for meals and entertainment. Remember, we used to be able to do some form of that prior to the Tax Cuts and Jobs Act, but it was limited to 0% of entertainment and only 50% of meals under TCJA. Well, we know meals and entertainment venues are the two industries probably most dramatically impacted by the coronavirus, and Donald Trump wants to provide an incentive for corporations to start entertaining and feeding people within those areas. In addition to that, most of you probably know there's a slight above-the-line charitable deduction for non-itemizers in the United States to the tune of $300 per year. While that sounds like peanuts, I wanted to make you aware of it, is because there is an effort to increasing that above-the-line charitable deduction to maybe $4,000 per an individual and $8,000 per couple. Now, that's sizable considering a lot of retired individuals, by nature that they don't have a lot of tax deductions, aren't itemizers, and they take the standard deduction. So this would actually come off before the standard deduction is applied as a top-line tax deduction. There's also additional discussion around additional required minimum distribution relief. You know that our RMDs were waived for 2019 or 2020, pardon me. There's some discussion about extending that into 2021 as well.
Jeff,
I alluded to the fact that we talked about trade and infrastructure in a little more detail, so let me kind of jump into the infrastructure picture. First of all, realize that everyone agrees we need an infrastructure investment in our country. The president, the Republicans, Democrats, everybody understands that. And that's because the American Society of Civil Engineers gives our current infrastructure in the United States a grade of D+. Now, that may have been good enough to get me through high school, but it doesn't make me feel very confident about going across the Golden Gate Bridge. Now, beyond that, we know that the Senate Republicans put forward a package of their own, suggesting that it should be around $300 billion over 5 years. Now, that would be very traditional infrastructure like roads and bridges, but they want it as a separate standalone bill. Democrats have just upped their infrastructure investment ideas around coronavirus relief to the tune of $1.5 trillion. It would be a very broad definition of infrastructure, including broadband and green initiatives and renewables and the like. But specifically, it would be inside round 4, and I'll explain kind of the subtle difference there here in a moment. President Trump himself has suggested that maybe it should be $1 trillion, and again, a part of round 4. Now, before you think $1 or $1.5 trillion sounds like a lot of money, that same American Society of Civil Engineers says that if we just want to get that D+ grade up to something above average, which I'm assuming is a C+ or B- grade, you need to have a $2 trillion infrastructure investment. And if you're so bold as to assume the United States deserves world-class infrastructure, that number is well north of $4 trillion. We're just that far behind in our infrastructure investment in our country. And the reason why nothing's been passed around that is no one could ever figure out how to pay for it. Do you increase gas taxes or bonds or fines or fees, or how do you do that? And it always fell apart on the funding side of infrastructure. And what I started predicting after the Senate or the House of Representative Republicans, the fiscal conservatives, lost a lot of power in 2018, that sets up a new dynamic for discussion around infrastructure investment, and that would be deficit-financed infrastructure investment. And the coronavirus sounds like a good tool to bring that forward. Not suggesting it's the right tool. I'm suggesting that it's certainly an open opportunity to talk about deficit-financed infrastructure investment. After all, the then presumptive nominee, Donald Trump, that said in 2016, "I'm the king of debt. I love debt. I've made a lot of money with debt." So clearly, Donald Trump would have an open ear to the idea of including it in round 4 and simply adding it to the additional debt we're already adding to our federal debt holdings. Now, if the Democrats and the president have their way, this would be, again, a very broad definition of infrastructure, and a lot of sectors would benefit significantly from that investment. The upside of investment spending is that we get a long-term return on those investments. Now, beyond that, talking about trade, we know we've layered on tariffs after tariffs after tariffs onto China. And as we predicted in early 2019, we would get a trade deal done, and it would be basically a détente. And that's exactly what phase 1 trade deal really is. It's just really the two countries saying, you know what, let's stop hurting one another. Give each other enough wins that we can call it a win for both sides. The bottom line, let's just stop hurting one another. What the U.S. gave up was a reduction in the tariff levels that we had applied and the avoidance of the tariffs on consumer goods that were scheduled to go into play on December 15, 2019. But what we do know is that that deal included a hard dollar buy. In other words, the Chinese had obligated to buy $200 billion of goods from the United States over the next 2 years, 2020 and 2021. But they've already told us very clearly that they're not going to be able to live up to those dollar amounts. Recently, they've ticked up some of their buys, but they're still woefully behind both on agricultural products and energy due to the coronavirus issue. So what was the penalty for not living up to those phase one trade deals? Is the United States was going to snap back all the tariffs on China. And that was going to lead us to a phase two if we got through phase one. And the concern I have is that the United States is actually being called to eliminate all tariffs, not snap back tariffs. No, eliminate all tariffs due to the worldwide pandemic. But that's actually led to a completely different dialogue here in the United States, as you've no doubt heard, away from building a stronger economic relationship with China to a discussion of delinking our economic relationship with China, primarily due to the Chinese withholding or a lack of accuracy around the virus data. But in addition to that, the awareness now through the coronavirus of how reliant we are on China and other countries for our strategically important goods, specifically medical and pharmaceutical products. Beyond that, we also know Beijing has used this opportunity, the coronavirus, to crack down on Hong Kong. And the United States are saying now that we don't see any difference between Hong Kong and China, not to mention living up to those phase one purchases. So what might the United States do? Well, we started predicting about 2 months ago that maybe we limit Chinese visas to the United States for students to come study here. And Donald Trump attempted to do some of that by suggesting that if it's a virtual learning arrangement, there's no reason that that person has to come to our country. So he tried to hold those visas back. Now, he's since backed off that. But we can certainly do a lot of other things as well. We can delist Chinese companies from the U.S. stock exchanges. We know there's sometimes a little lack of transparency around some of the data, and that could be used as an excuse to remove those stocks from the market. In addition to that, the U.S. Thrift Savings Plan, which is a huge retirement plan, as you might guess, could also no longer allow investment in Chinese companies. But more significant than that, we could also impose new tariffs on China and or Hong Kong for the imports to the United States, or prohibit those exports to those countries as well. One step further might be to apply sanctions, as we did with Huawei, but this would be sanctions on foreign countries doing business with China or Hong Kong, not unlike what we did with Iran. And we know certainly that impacted the Iranian economy dramatically. But bottom line is the goal would be to break the dependence on China for our strategically important goods. And the question is, how do we go about that? Do we provide tax incentives, or do we incent those corporations to bring those jobs back in a different way? Bottom line is we need to understand any action we take will undoubtedly solicit a response from the Chinese. They are not holding an empty hand at this point in this negotiation. And we see them already threatening to do some sanctions based on our sanctions applied earlier this week. Now, we're spending a lot of money. We're adding a lot of money to the debt. So let's talk a little bit about fiscal policy. Donald Trump famously said back in 2019, who the heck cares about the budget? Now, he used a little more colorful language than that, and I'll avoid that today. But bottom line, I think at this point, even Donald Trump would say we all care about the budget, right? So let's talk about what situation we're in. You see, the United States was not in a great situation even before the pandemic. Our revenues were projected to be very flat, even with the expiration of the individual tax cuts in 2025, while our expenditures were going significantly higher and at an increasing pace. That was due primarily to the debt we added between 2008 and 2020, and that's kind of a microcosm experiment of what we're doing around the coronavirus. You know, the financial bailout was to the tune of $870 billion, and you can see the impact of that inside this red circle. Well, you know that $870 billion fundamentally reset the publicly held debt to GDP ratio back in starting in 2008. But that was only $870 billion. Here we're talking about $3 to $5 trillion that we're going to be adding to the debt in a very condensed amount of time. So we have yet to figure out the real long-term impact of that, but we do know in the short term the U.S. deficit will exceed the GDP. The deficit will be over 100% this year. There's no doubt about that. The question is just how much more at this point. What we're really doing is testing modern monetary theory, or MMT. And pardon me, you probably already know this, but MMT simply says that if you're a sovereign country and you have the ability to print your own currency, you never have to worry about debt. You never have to worry about debt because you just print more currency to pay the interest. And I'm here to tell you with 100% certainty and positively, MMT will work until the day it doesn't. The problem is you never know when that day will be, but we do know what that day will look like. It's when buyers of U.S. debt, and remember the largest buyers of U.S. debt are you and I, our pension funds, our insurance companies here in the United States. Yes, China has a significant holding of U.S. Debt, but the single largest as a group buyer of U.S. debt are you and I, and our pension funds and insurance company. But those buyers go to auction to buy that debt. And there'll be a moment in time where the buyers go to auction, U.S. puts out their offering and shows their yield, and the buyer says, you know what, United States, I'm not real comfortable with your balance sheet. It's been going the wrong way lately. And if you want me to buy your debt, I want a little more yield in order to compensate for that risk. Perhaps significantly higher yield. That's when our country will be very challenged. Now, the half full kind of version of this interpretation would be to say, understand that anytime we're talking about these issues, it is a relative measure against other OECD countries. And the, I guess, perverse blessing of the worldwide pandemic is that it's affecting all economies around the world. And so none of us know how that relative measure will look once we're past the coronavirus. That will be the time when all of these things start settling out and could significantly impact the cost of carrying that significantly larger debt for our country. Now, the Fed has continued to be very accommodative by low interest rates and suggesting they'll keep them low for as long as necessary. They're also announced unlimited quantitative easing, just like in 2008. But as you know, the Fed can't buy non-federally guaranteed instruments. So they effectively merge the Fed and Treasury, and allowing the Treasury to then buy these assets with federal dollars. Now, they also backstop the money market. They're set up an international repo facility for U.S. Treasuries because we didn't want to run on U.S. Treasuries as other countries were having to liquidate assets to raise cash to deal with the virus. And that repo facility prevents that run on our Treasury. In addition to that, the Fed had set up some two additional lending facilities of substantial size. The 4-year bridge financing are for large industrial companies, think Boeing and companies like that. But the more impactful program is the Main Street Lending Program. And that was really meant for medium-sized businesses. Now, these are non-forgivable loans, so they're not like the PPP, they're non-forgivable, but they made some recent changes that I want to make sure you're aware of. They extended the life of the loans to 5 years. They also lowered the minimum loan to $250,000 for quote-unquote certain types of loans. Now, they didn't really define certain types of loans, but the lackluster interest in the Main Street Lending Program as of yet probably will motivate them to lower that minimum for any loan to $250,000. They extended the deferral of principal payments for 2 years instead of the original 1. They increased the number of employees and annual revenues for companies that can qualify for Main Street lending from 10,000 employees to 15, and from $2.5 billion to $5 billion. They also increased the maximum loan size to $50 million, but there's a calculation of how much your organization could actually qualify for. One thing they have not clarified yet is whether nonprofit firms can participate in Main Street lending. I fully anticipate that they will, but it's not official at this point. I know a lot of you probably sit on boards, and the Main Street Lending Program may be a very viable option for you. I think you will have that option of Main Street lending, just not quite yet. Now, there are some interesting planning opportunities provided by the reality we're living in 2020. I want to share some of those with you. For example, we know in 2020, if you took a required minimum distribution, you'll have until August 31st to return it. It is no harm, no foul. It's like you never took your RMD for 2020. If you don't need that for income, which a lot of retired people don't, that's a great opportunity to refund that back to your investments and avoid taxation on those dollars. I can't think of a better year to consider a Roth conversion. You know, with a conversion, you take fully taxable dollars, you pay taxes on it, and then you put it into a tax-free growth environment. Well, right now, at various periods during this year, and I anticipate some again this fall, there will be some significant market volatility. You can sell those assets at a lower value. I assume everyone's income, like mine, is down this year. So your income tax exposure is down as well. So you really get to win twice with a Roth conversion in 2020. Beyond that, I know a lot of clients have pulled away from equity markets with the fear of volatility. Consider maybe an annuity to help you give confidence to your idea of staying properly asset allocated. It's not right for everybody, but for clients who are otherwise going to be too conservatively invested, it may be an option for that type of client. Beyond that, the most predictable bear market in an investor's life is a long-term care incident. We know one out of every 2 retired clients will have a long-term care need in retirement, and it's a big ticket item. So to the extent that your wealth is such that you can self-insure that, no problem, don't worry about it. If your wealth is such that maybe you could self-insure it, it may make sense to offset some or all of that risk to an insurance company with the likelihood of a 50-50 that you and your spouse may incur that long-term care expense. On the charitable side, there are a couple of interesting opportunities. I mentioned earlier that $300 above the line deduction for non-itemizers. I want to mention it again. I would not be surprised if that $300 grew, and that would be a fantastic way to do some charitable planning if you're a non-itemizing individual. Beyond that, if you are an itemizer in 2020, you can take up to 100% of your adjusted gross income as a charitable deduction. Again, it's a great year to be thinking about your charitable giving. I know with my own parents, I've been a lot more aggressive in 2020 around their gifting because I'm not sure how long I'll have that opportunity. So we accelerated some of their 2021 gifting into 2020. Now, all of these things lay across the backdrop of the election, so let's jump into the election. We know that Democrats now have effectively named their nominee, Joe Biden. It sets up this race between Joe Biden and Donald Trump. And I think you'd agree with me that Donald Trump is a polarizing figure, but you would also have to agree that Joe Biden's not really leading a Democratic movement at this point. And that's what makes 2020 such a fascinating race to delve into. But back to the Democrats for a moment. Just because they've decided on Joe Biden as the nominee, it does not mean they've settled the internal debate within the Democratic Party. That debate between progressives and moderates of the Democratic Party are playing out actually right now as they start trying to put together the Democratic platform they want to run on in 2020. What we've seen is the progressives certainly have the energy, but they seem to have a lot more influence than they did back in 2016 as we see Joe Biden bending his platform in a little more progressive direction. 2 reasons. One, the progressives have all that energy and excitement. He needs to keep those people engaged. But second of all, he's feeling more and more confident that he can win convincingly in November. Therefore, he can take a little more risk and be a little more progressive. Speaking of Joe Biden's platform, it probably makes some sense we spend some time there. It's been a long time since we've seen him really delve broadly into that platform, since the debates and so forth. So let's kind of review his platform quickly. On the healthcare front, his goal is to increase affordability and decrease the number of uninsured. Well, how about you? That sounds like every single politician you've ever heard, right? That's everyone's goal. But let's talk about how Joe Biden proposes that we make that happen. First of all, he would lower the age of Medicare eligibility from age 65 to age 60. That was a nod to Bernie Sanders and the progressives. Joe Biden announced that the day after Bernie Sanders got out of the race. Beyond that, he would also end surprise medical billing, which is a pretty bipartisan issue. But what's not a bipartisan issue is that Joe Biden supports a Medicare-like federal option within the Affordable Care Act exchanges. So this Medicare-like federal option, nonprofit obviously, would compete side by side versus commercial offerings. What we know is that anyone would be eligible to participate regardless of age, and if you think it's a better deal than your corporate offered health insurance, you can enroll in that Medicare-like option. In addition to that, the 31 million uninsured in our country would be auto-enrolled in that Medicare-like option. In addition to that, he would raise premium subsidies within the Affordable Care Act dramatically in 2 ways. He would decrease the percentage of monthly income that can be allocated towards medical premiums to 8.5% of income, down from about 9.6%. But if we base those subsidies not off the silver plan as it is today, he would base it on the gold plan. So the combination of those two things would increase those premium subsidies dramatically. On the pharmaceutical front, he would allow Medicare to negotiate for drug prices, which is a little bit ironic considering he takes a lot of credit for helping pass the Affordable Care Act. It's the Affordable Care Act itself that prevents Medicare to negotiate nationally for drug prices. So that's a bit of a reversal there on Joe Biden's front. Beyond that, he would accelerate the use and approval of generic drugs. He would tamp down on Big Pharma's efforts to extend their patents by just tweaking their formulas ever so slightly, but renewing their patent. All of those things would be limited and get more generics in the system. On the Social Security front, he says he would eliminate means testing, although he didn't give any details. The only thing I can think of is what he means is that income offset. As you know, if you are receiving Social Security, but you're continuing to work, you get a reduction in that payment. I'm assuming what he means by the means testing is eliminating that income offset. In addition to that, if you've been on Social Security for 20 years, you would actually get a raise. So theoretically, age 85 or 87, you would get just a one-off raise in your Social Security monthly income. He'd also increase the minimum benefit to 125% of the poverty level that has shrunk dramatically with the low cost of living increases over the last couple of decades. On the retirement front, there are 41 million Americans that still lack access to a qualified plan at their place of employment. He would set up an automatic 401k, a federal-like 401k, that if you are working and you don't have access to a qualified plan at work, you could participate in the federal 401k program, not the federal employee program, the thrift plan, a set up 401k through the federal government. In addition to that, he would increase the federal minimum wage to $15 an hour. He also has some very aggressive ways to make college more affordable, as well as to pay off and forgive student loans. And just out of interest of time, I'll let you come back to this. At the end of the presentation, I will give you the opportunity to take a snapshot, so have your cameras ready, and that will give you access to the entire presentation. But the biggest change he would make on the student debt front is he'd make student loans dischargeable by bankruptcy. As you know, right now, they're not. So that would be a significant change around student debt. He just this week announced his economic plan to boost U.S. manufacturing. It includes a $700 billion federal investment, both in R&D, but also government purchases of U.S. manufactured goods. Now, all of these things have a very medical bent for obvious reasons, given the coronavirus. But bottom line is he wants to double down on reinvesting in U.S. manufacturing. Now, I don't know about you, but that sounds awfully Trumpy. It sounds like Donald Trump's platform, X the medical part. And there are a lot of similarities between what Joe Biden's talking about right now in U.S. manufacturing, as well as Donald Trump's 2016 platform, and what, again, I presume to be his 2020 platform and beyond. Understand, though, if we take these measures like renegotiating TPP to kind of squeeze out China, we end the phase one China trade deal, we review trade tariffs on steel and trade and perhaps increase them if they're from foreign countries, all of those things will solicit foreign reaction and retaliation. It also means U.S. consumers are going to pay higher prices for these broad range of goods. Not suggesting that's a bad thing. Maybe it's what our country needs to get back on our feet. I'm just suggesting that that's what we need to anticipate. Joe Biden would also make a significant infrastructure investment. He just upped his number from $1.3 trillion to $2 trillion, and obviously have a very significant bent towards green New Deal, towards renewable energies and the like. Now, to Joe Biden's credit, at least he has come out with how he wants to pay for all of these changes. On the personal tax front, he would eliminate the Tax Cuts and Jobs Act for the wealthy. It's somewhat ambiguous as to who he's calling wealthy. We know President Obama defined it at $250,000 income. Joe Biden seems to be leaning more towards $400,000 of income being quote unquote wealthy. He would increase the highest marginal rate back to 39.6%. Probably more dramatic to our discussion today, as investors, he would bring parity between capital gains and marginal tax rates for those high income earners. So if you earn a certain amount on an annual basis, if you sell a long-term capital asset, you wouldn't pay a reduced capital gains rate. You would pay the same as your marginal tax rate. Obviously, that would dramatically impact your dialogue with your financial advisor about buys and sells and so forth. So just kind of keep your ear to the ground on that. He would also cap itemized deductions for high income earners at 28%. So even though you may be paying 39.6% on your last dollars of earnings, you're only going to get 28% tax deduction on any deductible expenses. He would also reinstitute payroll taxes above $400,000 to the tune of 12.4%. All of those things would mark a significant increase in taxation on individuals. On the estate tax front, he would lower the unified credit back down to $3.5 million, although he doesn't specify a tax rate, so we don't exactly know what rate. But more impactful is he would eliminate stepped-up basis at death. So the combination of those two things right there means there is a significant wealth tax at your passing under Joe Biden's plan. On the corporate tax front, he would increase the corporate rate from 21% to 28%, and he'd institute a 15% minimum book profit tax. Now, book profits are a little bit unusual. You've probably heard that some tech companies pay no federal income taxes, but yet in their SEC filings, they're saying they're making all this profit. Well, the profit they're reporting to the SEC is book profit, and Joe Biden would say that has to be taxed at a minimum 15%. So let's kind of move our dialogue away from Joe Biden's platform into the national election. And what I mean by that is I want you to be wary of national polls. You know, we all know national polls are wrong because we don't elect a president via popular vote. So by definition, there's just way too much slop in national polls. But you can look to national polls for two things. Understand they only do these two things. They influence perception and perpetuate momentum. If you understand that, it'll give you a little less heartburn over the roller coaster we're likely going to be on for the next several months. But what we do know, if you look at approval and disapproval numbers, Donald Trump is underwater on not only on his job approval, but on the top three issues for U.S. voters. Interestingly, and not unexpectedly, civil rights and civil liberties took the third spot away from climate change, given the challenges our country has faced over the last couple of months around the George Floyd killing and so forth. But what you can see is that Donald Trump, the one area he does outperform his personal approval rating is around the economy. So it's no doubt he'll do anything and everything he can in order to keep the economy moving. What is interesting is you see there's still a significant number of undecided, and that's about where we'd anticipated 4 or 5 months out from an election. So we'll see how that shrinks over the next couple of months. There are some unique coronavirus risks, I believe, to Donald Trump, and they're in 4 areas: capability, credibility, governors, and the economy. Capability, meaning this is the first national crisis he's had to manage, so it's only natural that you and I as an electorate judge him on his capability of handling what is sure to be a second national crisis and a potential second term. Credibility really comes down, do his words match reality of how people feel? In other words, in September, if he's saying, oh, we're almost through this, it's all over, everything's great, but people are still unemployed, there's a disconnect there, and it goes to that credibility issue, as well as the economy. Governors are simply that he pushed a lot of this responsibility, and rightfully so, down to governors, so that begs the question, well, who will get the blame or the credit if things go badly or well? And it just kind of adds that layer of filtering around this coronavirus issue. Now, 2020 was always going to be a big turnout election year, and obviously the coronavirus is tamping that turnout issue down, but a lot of people think that mail-in balloting is the holy grail. Well, let me clarify a couple things. First of all, understand that primary voters are much more savvy than general election voters, and we've seen primary problems all throughout the country. Now, magnify that by the number of people voting in every state and all 50 states and plus territories. It's going to be a huge issue for us this fall. The good news is the 17 most competitive states in 2020 all have mail-in balloting in place, so nothing has to change. But the participation is vastly different across our country. Some, less than 10%, vote by mail, and other states mostly vote by mail. So you can see that there's a lot of education that has to take place there. That's because every state has their own rules around ID requirements, timing, signatories. Some states even still require notaries for absentee ballots. So you can imagine how challenging and confusing that will be for the quote-unquote average voter. Now, the 3 of the 4 most important states, Pennsylvania, Michigan, and Wisconsin, they have mail-in balloting, obviously, but they have split governments. So they have a Democratic governor and Republican legislature. So you can't count on any legislative help between now and election time to try to make mail-in balloting easier in those 3 critical states. And it's all these things that add confusion and slower turns and last-minute changes and what happens if there's a hot spot where you normally vote and so forth that bring in this question of election legitimacy. This is probably my biggest fear for our country here in this short term, say the next 5 months. And what I mean by that is Donald Trump is clearly setting up a legal challenge if he loses the election under the idea of voter fraud. And you know what? Joe Biden's not helping it either, suggesting that Donald Trump is trying to steal this election. And a lot of people will say, well, hold on a second. You know, the Supreme Court is likely going to get involved, and they're not going to overturn the will of the people. But understand, either candidate would have to swing just enough votes in just enough districts, and maybe as few as 1 state, and it may very well swing the election. Again, adding to this issue of election legitimacy. Now, as I said earlier, we do elect a president via the Electoral College, not the popular vote. And we know California and New York and Massachusetts, they're going to go for the Democrat. And we know that Alabama and Oklahoma and probably Texas, I don't think Texas is going to go Democrat this year, are going to go Republican. But when you bifurcate those known states out, you see the Democrats already have a lead towards that 270 votes. And there are only 6 real competitive states, and I have them listed here for you. All 6 allow mail-in balloting, so there's not an issue there. But here's how the math works. Because Donald Trump is behind in the initial vote count, he really has to win Florida. I have no idea why Florida is not getting more attention in 2020, because if Donald Trump doesn't win Florida, I don't see how he can win this election. Because even if he wins Florida, that only brings him basically at a tie with Joe Biden, and it's a dog fight for the rest of the 5 states. If Biden wins Florida, he only has to win 1 of the remaining, and he's the next president. So you can see the math is just heavily against Donald Trump at this point, not dissimilar to what the polls are showing. But I don't know about you, that sounds a lot like 2016. And that's exactly our point. Bottom line, there's still way too many variables. I remind you all the crazy things that happened in October of 2016 around Russia and the Hollywood tape and Hillary's emails. All those crazy things happened in a 3-week period. So a lot of things, what I believe is that we don't know what's going to influence this election one direction or another. But certainly if the election were held today, Joe Biden would win. No doubt about that. But that's not the same as November this year. What we know at the House level is the Republicans need to take back 19 seats, but there are only 22 districts that are actually considered competitive. So Democrats only need to win 4 of the 22 to keep their majority. So right now, it's pretty obvious the House will stay with the Democrats. On the Senate, it gets a little more complicated. Right now, they need to pick up 3 seats if they gain the White House and 4 if they don't. But there are 35 members in this class, but there aren't that many competitive states. The toss-up states for the Senate are Arizona, Colorado, Maine, and North Carolina. Ironically, very similar to the toss-up states for the presidential election. You also have to assume that Republicans will take back Alabama. They now are running Tommy Tuberville, the ex-Auburn football coach, obviously pretty popular in the state. So it's likely they'll take back Alabama from Doug Jones. But that changes the math dramatically. Now the Democrats need to win 4 seats if they take the White House, and 5 if they don't. That is a very hard road to plow. That being said, though, if Joe Biden wins, he's winning in these toss-up states. And if Joe Biden wins in those toss-up states, it means the Senate Democratic candidates are probably having a good day too. So if Joe Biden wins, the Senate's at a 50-50 in our call right now. Now, why that's important is if the Democrats are successful in winning the White House and the Senate, as well as keeping the House, they don't need a single Republican vote to completely overhaul the tax code once again. When we talk about the tax code being temporary going to 2025, I'm telling you, if that scenario happened, we would have a brand new tax code as early as tax year 2021. And one thing the Democrats are very consistent on is what they want to do is to increase the progressivity of the U.S. tax code. In other words, higher income, higher net worth individuals shouldering a larger share of a larger federal tax take. Something we need to be aware of as investors and the like, that's a possibility in the more near term than we originally anticipated. The only other race we're really watching are the state races around governors and state legislature controls, because it's the governors and legislatures sitting in 2020, not necessarily elected, but sitting after the 2020 election, that will redraw those House district maps for the federal government. And those maps go into play in 2022, and they're good for 10 years. So these governors and legislatures will likely dictate the future, the majority of the House of Representatives for the next decade for our country. So that's kind of why we're keeping an eye on that as well. Now, I probably overstayed my welcome. I hope I haven't, Omar, but you're more than welcome to follow me on social media. I usually post 3 or 4 articles a day that I think are uniquely interesting for whatever reason. We don't charge anything for that. We don't sell anything. It's just thank you to Hightower for having me here today, as well as the fact that if you are interested in getting the entire presentation, you're more than welcome to it. You can just open up your phone camera, focus on this QR code on the right side of the page, and it will give you an opportunity to share your email address, and I'll email out the full presentation. Again, I just want to thank you, Omar, for having me, and thank Hightower as well as Eaton Vance for sponsoring me here today. I look forward to seeing what questions you have.
Yeah, thanks so much, Jeff. That is a unbelievable amount of information in about 45, 50 minutes. So I think we'll all need some time to digest that. Thank you. Just an incredible job. So, you know, there's a lot of concern. Obviously, most of the people on the call are clientele or high net worth investors. And so a lot of this centers around sort of, you know, taxes. You know, we're fortunate to have our clients be extraordinary, charitable, and things like that. So, you know, we understand that Biden effectively wants to kind of undo, if you will, anything that's been done in the last sort of 4 years under Trump. On the Trump side, has he proposed anything different versus what's currently in place? You know, should he win, or should the Senate, you know, stay in Republican hands?
Yeah. Well, I think we have to be honest with the fact, I don't think the Republicans have a platform yet. The Democrats are somewhat coalescing around Joe Biden's programs that will tweak during the convention. The whole convention process is about refining those platforms and then coming out as a unified party. I think it will look a lot like what Joe Biden has proposed, maybe even a little more progressive. But reality is Donald Trump really hasn't spelled out a platform for 2020, and the Senate Republicans and the House Republicans, they're not going to get in front of the president. So we know that's a a dangerous trail, as we know, getting in front of Donald Trump if you're a Republican. So really, they're waiting and sitting back and saying, okay, Mr. President, we got to come out with something. You have to run for something to give people something, a reason to vote for you again. So we don't know what that is at this point. The only tax changes that Donald Trump is really talking about are specific to the coronavirus relief at this point, not really any longer term solidified vision that I would say, you know, this is what Donald Trump stands for and what to expect.
Yeah,
Keep in mind, though, in order for Donald Trump to get anything done through the tax system, he would have to also take back the Senate, or the Republicans, or excuse me, the House. And I just don't see any scenario where the Republicans take back the House.
Yeah. As much as we talk about the polarization between, you know, the Republicans and Democrats, the reality is internal to their own parties, you sort of have a left and a right, and there doesn't seem to be a lot of agreement, you know, within the parties themselves. So we just have a couple of minutes left. You know, let's talk about the national debt. You know, I'm just curious, you know, we went through over the last 10 years, all of these debt ceiling showdowns, and then we had to, you know, these artificial limits on the debt ceiling, and so much talk about that. And that has just, you know, completely disappeared, I guess, under the guise of, you know, don't let a good crisis go to waste in Washington. Does anybody care anymore about the national debt?
Well, I would actually backdate that. I would say that once the Republicans had full control, they didn't care about the debt either. You know, the debt is always one of those things that it only matters when you're not in power, because the other guy or person, the other party, is spending money still in a stupid way. Because when I'm in power, we only spend money in a good way. You know, so it's a bit of a hypocrisy around this whole debt issue. The reality is, no, nothing will constrain Democrats or Republicans from continuing to grow the spending and the debt in the United States. Nothing will constrain them except buyers of U.S. debt. And that's that date of reckoning that I kind of mentioned earlier. It's all up in flux around the world because the entire world is dealing and responding to the pandemic. It will be an analysis that will be vital to our country's stability once we're through the pandemic, because then we can relatively compare, well, how do we come out of this thing compared to China and EC or EU and so forth. That will be the real, I think, the triggering place where buyers of debt say, you know what, if you want me to buy your debt, US, I need a little more yield. And the problem is, as you no doubt know, that curve I showed you was assuming very low interest rates for a long period of time on the pre-pandemic debt. So we know that's going to jump up just because of gross debt holdings. And then if we get an interest rate increase, and it doesn't have to be sizable when we're talking about these kind of numbers, that's when that day of reckoning will hit.
Yeah. And I think from my investment seat, I think that's that's where we obviously spend a lot of time, is that the interest rate on really safe stuff is pretty much nothing. We used to call it the risk-free return, and now it's the return-free risk to own a lot of this stuff. So with that, and I think just to conclude, a couple of notes. Number one, we will make this is being recorded, so we do have a recording available for anybody who's on here who'd like a copy, and we'll post it for any friends or family members who might want to tune in later. And then I would say too, a lot of the information in here will affect individual people in very specific ways, in ways that typically can't be generalized. So I'd encourage anybody who's either a current client or who has questions that might pertain to their particular situation, please reach out to us on the team. You can email the Q&A at Hightower STL, or just email the folks that you normally work with, so that we can kind of unpack the implications of a lot of this around taxes and estate planning and asset allocation and all that fun stuff. So with that, thank you once again, Jeff. Really a tremendous amount of information, very helpful, very clear. So we really appreciate having you here. And we'll get the popcorn and the box of Kleenex ready for the next couple of months, or we'll need it. So thank you.
Absolutely agree. Thank you for having me.
Bye-bye.